for this one is obviously inspired by China Evergrande's current saga. Reading in comment sections, I've seen some who say, don't buy China stocks, stay far away from it. I've also seen some who say, I'm buying this, or you should consider that. Now, each and every person is entitled to their point of view, so let's respect that. And in any case, anybody could be correct also. But if you're looking for ideas, how you can get involved into this whole current saga, what are investment opportunities, maybe I have something prepared for you. In today's video, I'll be covering 5 investment ideas that spans from bonds all the way to equities. Equities from Australia to Singapore and even to China. So maybe there'll be something that catches your attention, and with that, let's roll in the intro video. Hi guys, welcome back. Now in today's tutorial, I'll be ranking the ideas in terms of the least preferred all the way to my most preferred idea. So stay tuned to the end. Now number 5 on today's list is actually to buy into Country Garden. Why Country Garden? If you look at this chart over here, you realize that China Evergrande indeed derives the most revenue. But following close behind is actually Country Garden, who is actually the biggest developer based on market cap in China itself. Country Garden is right now purchasing Guangzhou R&F's assets, because Guangzhou R&F, if you follow the tutorial so far, is one of them that is also in trouble. And the irony is Guangzhou R&F have themselves spent their monies to buy Yanlord Group very recently only. So this play on buying Country Garden is really a concept. Is it too dangerous to let 2 developers fail? Because my assumption is China Evergrande might really fail. And if one is going into default, then it will really cause systemic risk if the top few developers all go into defaults. But in any case, Country Garden is a lot more financially sound than China Evergrande. Even though in terms of share price, Country Garden has actually suffered a loss of about 30+% in comparison to China Evergrande, who has lost more than 80%. And if you look in terms of price to book for Country Garden, you realize that it's right now trading at a very distressed price. But again, book value, can it be trusted? It really depends on the accounting integrity as well as the inventory, whether it's going to hold its value or not. If that, maybe I'll throw in a second name just to add more flavor. China Vanke is also another property developer which is not too distressed yet. You realize that they have not lost too much in terms of value, and maybe a developer that could also emerge from this crisis stronger. Now let's think back on what happened in global financial crisis. When we saw Merrill Lynch go down, when we saw Bear Stearns go down, you realize that they've actually been acquired. Bank of America actually purchased Merrill Lynch, and you see, they've actually survived the global financial crisis and have more or less recovered their value from that crisis itself. What about JP Chase? They actually bought Bear Stearns, and if you look in terms of share price, JP Chase is at least worth twice from where it was from global financial crisis. So again, every crisis will have winners emerging from it, and my guess is Country Garden could be one of them. Number 4 on today's list is ICBC Bank. Now, ICBC Bank is the biggest in terms of assets of all Chinese banks. If you see this chart over here, you realize that they are ranked number 1. And what we do understand from the situation so far is ICBC, of course, has exposure to China Evergrande, and they have a lot of loans into the property sector itself. But if we assume ICBC could be too big to fail, they may also emerge from this crisis eventually. ICBC has lost about 24% for the last 6 months, and right now it's trading at a distressed price. Its price to earnings ratio is a meager 3.86 times only, with dividend yield of 7.64%. Now, if I'm not wrong, Temasek used to own a stake in ICBC. I don't know how big that is remaining now, but ICBC, if it fails, I think it's definitely going to cause systemic risk to the whole Chinese banking sector. I have a further point to add. What if instead of buying just ICBC, buy broad-based, the entire Chinese financial sector, then consider CHIX. This is actually Global X MSCI China Financials ETF, and within it you'll see top holdings such as China Construction Bank, ICBC and Ping An Insurance. The industry breakdown includes major banks, regional banks and insurers. If the entire sector recovers after this whole saga, naturally your investment will reward you. Leave your thoughts and comments in the sections below. And with that, let's move on to number 3 on today's list. Number 3 on today's list is actually not an equity, it's actually Asian bonds. Why in the world is Asian bond a proxy to this whole opportunity that's happening with the Chinese property market? If you look in terms of this chart, you realize that property makes the biggest share of Asian high-yield bond market. In any case, if you don't know high-yield bond, it's actually junk bond, which means non-investment grade. And to simplify things, it also means that the risk of default is slightly higher. And if we look in terms of a typical bond fund, what does it actually show? This is Blackrock Asian High Yield Bond. You realize that it owns more than a benchmark in terms of financials and more than a benchmark in terms of property exposure. The average credit rating is BB and B. And in terms of geographical breakdown, it's overweight in China. If you want to know specifically which bond funds have China Evergrande's bonds, I have this summary table for you. At the bottom of the list, you realize that Blackrock Asian High Yield Bond has 1% exposure to China Evergrande's bonds. So if you're more interested in China Evergrande's bond, you can actually follow this table, look for a bond fund that suits you, or if you're keen to avoid China Evergrande bonds, then don't look for names within this list. But are still exposed to other companies in the space of Asian debt. Then let me pivot to some comments made by PineBridge Investments. Evergrande's US denominated bonds approximate to about $19 billion or 5.5% of the JACI High Yield Index and will move up the default rate statistics. However, current credit spreads in Asian high yield, even if we exclude China Evergrande, are pricing a close to 10% implied default probability. In my understanding, in simple terms, that means that Asian high yield bonds are currently over bearish in terms of outlook. And if you look in terms of the yield currently right now for Asian high yield bonds, you realize that it's double digit, more than 11% on a bond yield. Interesting, correct? So if you agree, smash the like button because it's taken our team hours to prepare this for you. And again, invite you to smash or subscribe. I'll be launching more videos to help you in your investment journey. So with that, let's move on to point number 2, which is actually a Singapore listed company. Number 2 on today's list, I've actually looked across many names, and my final decision to share with you is actually Yanlord Land. Yanlord Land has lost about 70% since May and gives a dividend yield of more than 6%. But the comforting point to note is CEO Zhong Shen-jian has actually bought in shares before at $1.15 and he owns more than 71% of the company. And if you think about it, since Mr. Zhong already owns 71%, wouldn't it make sense if the company becomes too undervalued that he decides to privatize it? It is always a possibility. And if you haven't seen Yanlord Land too much, let me introduce them to you. The majority of the business is definitely in China. China's source revenues constitutes almost everything. If you look in terms of the business segment breakdown, you realize that property development is the bulk of things. And of course, that's derived from residential property. But if you look in the later few years, especially since 2019 onwards, you realize that there's slightly more focus on property investments and hotel operations. That is likely due to its privatization of United Engineers, which is done since 2019. Yanlord Land has been paying steady dividends the last few years, and I believe that they will continue to be sound. And with that, let me introduce you to the number 1 idea for this month, which pays a dividend that is even higher. Number 1 on today's list, drum rolls, but actually you've seen from the title transition, BHP Billiton or Rio Tinto. But before I explain a bit more details, let me show you the background of the story. This chart actually shows China Evergrande's share price matched with the current price of iron ore. What do you realize since May 2021? They've tumbled down hand in hand, correct? The correlation is very strong. And why is that so? Simply because China Evergrande is the world's biggest consumer of iron ore. Iron ore is of course needed for construction of residential properties and stuff. But the key part is China Evergrande, whether it defaults or not, China is not going to stand still. Their buildings are still going to get completed. Their cities are still going to be built. They are still going to see rapid urbanization. Which means this plunge in iron ore price, in my opinion, is not going to last forever. Iron ore prices will have to stabilize and eventually pick up if more buildings are to be constructed. That is why you see articles like this. BHP Billiton, Rio Tinto and Vale stocks look cheap based on current iron ore prices. In any case, these miners do not just mine iron ore. You can see coal coming out, you can see precious metals coming out from their operations. And these companies have a business operation mode. Not anybody can come into the mining industry and do mining like what they can do. That is why they're the number 1 on my list today. Let me show you the chart for BHP Billiton. Realize that it's plunged very recently, correct? Right now if you buy it, it's a price that was last seen in November 2020. The price earnings ratio for BHP Billiton is only 12.23 and the dividend yield 10.68%. What about for Rio Tinto? Realize that its price earnings ratio is only 6.23 and dividend yield at 9.13%. In any case, Rio Tinto has outperformed BHP Group for the last 5 years, and my preference is always to buy the winner. Both of these stocks are listed in Australian Exchange, ASX, as well as NYSE in US Exchange. So what are your thoughts? Have I identified the best idea? Leave your thoughts and comments in the section below and smash the like button if you agree on them. And with that, I'd like to say a big thank you for sticking to here. And let me introduce you to last month's presentation on top 5. You'd see Hong Kong Land, and it seems to be doing well right now. With that, I'll sign off from here and see you there too. Take care and goodbye.